Hello, everyone. It's a lovely, lovely day. Um, so, first off, if you're on Instagram, sorry for the previous times when I was utilizing Instagram via Ecamm Live. I know it had like a split screen, so I was like over here. The only problem is you're not going to be able to see any of the visuals I pop up today, but hey, whatever. It's the weekly rundown. You can follow along. You don't need necessarily the visuals if you don't want it. But as always, hey, first, let's talk about something important. Happy New Year. Hopefully everybody had a wonderful new year and it was smooth sailing for all of you. Hopefully you have some New Year's resolutions. If not, don't worry. I've got a blog coming up next week about that, which, by the way, didn't write a blog last week. It felt great. I actually took a vacation. Anyhow, Happy New Year. Now let's get into the swing of things. The first thing let's talk about is actually what's the market year-to-date performance. Well, since it's the start of the year, a new baseline has been set. So you can see, just really take a quick snapshot in time. You can see where the 30-year mortgage rate is starting at the start of this year. Fed funds rate, the prime rate, all of that. So really no change there. Bitcoin has a slight uptick, and then the three major indices had a slight downtick. But still, this is our baseline. We're going to be able to measure against that in the year ahead. Hopefully it's positive and there's a lot of green on that page. Now, before we get into our top 5 stories that I know everybody is so thrilled about talking about, I first want to do our standard LinkedIn question. And it's a really simple one because at the start of the year, I know a lot of the times employers, if you're an employee of a company, are offering new benefits and sharing that with every employee out there. And one of those common benefits is a 401k. So it's really a big question for you. Do you think a 401k is the best strategy for a comfortable retirement? I think you guys might know my opinion by now based on how many times I've had a conversation about this. But nonetheless, I wanted to get that out there and see what others might think. So let me know what you think. You can easily vote for that. It's just a LinkedIn poll. It's active, I think, for another 3 days. So yeah, let me know what you think about it because I want to just know if I'm crazy or if somebody else is crazy. Now, let's get into the really fun stuff, right? Our top 5 stories. And so let's start with watching out for the apartment dips that are coming in this year ahead. Now, why is that a watch out? Well, depends who you're asking, right? And just this little graph right here, this actually shows that 60 cities on a year-over-year basis had a decline in their rental rates. That's actually going to potentially increase over this next year. Because when you looked at just like the Q4 numbers, there was about 83 out of the 100 major cities had a decrease than the prior year's prices. Now, historically speaking, rental rates have always dropped in the winter time frame, and it's always hot during the summer, early fall. But then it's right after kind of that September 1 timeframe that's just like, you better have tenants in place. If not, you're going to be expecting a lower rent amount. And so like the biggest city with the biggest drop was actually Oakland. They had about almost a 10% year over year drop. Now it's important to note that other parts around the country are not seeing the same thing. So the Sun Belt region is experiencing an adjustment due to just excessive supply coming online now. Meanwhile, like the Midwest and the Northeast, where I live, we're actually seeing a rise in demand, and so there's less rent decline from a price standpoint. But nonetheless, if you're an investor out there in the space, exercise some caution as there's plenty of indicators that we've seen in 2022 and 2023 now where there's been like a 70% decrease in multifamily sales year over year. We saw the same thing on single family homes. There's a record number of fewer sales than prior years. So that's also like a 12.1% decrease in overall property prices of multifamily. So again, if you're a renter, hey, congratulations. You might be seeing some lower rents, especially if you can time it in some off-peak times where landlords are trying to fill that demand. If you are a landlord, though, or a property owner, make sure you try and line up as many of your leases during those peak months so you have a better chance of fulfilling your demand. So that's the first one I wanted to hop into. But another one where I wanted to talk about, since we're talking kind of about cities, is where are all the jobs going? Because again, if you're a real estate investor or if you're somebody that wants to make money, um, real estate investors, we look for a few major indicators. That's positive population growth, employment growth, landlord friendly cities and state governments. Like those are the major indicators. And then, like, if an area is turning, like if you want to get really micro into it, and so one of the best things for us to track is actually where are jobs moving to. And then, of course, if you're somebody that is out of a job or trying to find maybe a better job in the future, then you might be interested in these cities as well, because with more supply of jobs available, there might be better benefits, total salary, etc. for you, because they're trying to fill those positions and motivate more people possibly to move into the city or state to take such a position. So the cities that are performing the best in this space, it might come as no surprise. Texas really stands out here. You have major companies that have announced that they'd either move to Dallas or Austin. So that state is really performing well. Florida and Georgia and Arizona all are having some positive growth. Um, you don't hear New York. A lot of people, of course, flocked from New York and other major cities during COVID. And for those people that didn't want to come back after COVID, they, of course, tried to find new jobs down there. And smart companies tried to make it work if the employee was actually really good. The only major city that I should note in the Northeast is Philadelphia. They experienced a substantial increase, and many people speculate it's because they're only an hour from New York City. So it actually allowed for people to still be close to New York City if need be, but they can get into a major city like Philadelphia. Sorry, one second, got to pick up this little guy who's a little upset. Okay, kids, why don't we grab your milk too? Poor crew has been a little sick this past week. RSV has hit the house. Also the stomach bug. So he's living his best life. But you know what? He's alive still. So that's what matters. So crew, say hello, buddy. Good. All right. So the kid has distracted me a bit. We just finished up the job growth part, right? So now I want to move on to jobs overall, because jobs is a very popular topic. Okay, buddy. And so the real question is like, are people always having jobs a really good thing, or is it a bad thing? Because jobs is pegged a lot against inflation, and so they had to increase interest rates to potentially make it a more competitive job environment. Because at its peak, and that was in like 2022. At its peak in 2022, there was about a 2-to-1 ratio for job availability versus people wanting jobs. That has shrunk now to about 1.4-to-1. So it's still above the 1-to-1 ratio, but that is declining. And when you look at another major contributor, which is called the ISM, it's a manufacturing report, but they recorded a 47.4. Now, anything underneath 50 counts as a contractionary environment. Now, it's not a significant drop below 50, but nonetheless, this indicates that it is a contractionary environment. And the Fed closely monitors these job numbers because it's a sign of labor slack. And a historically tight labor market, which contributed to a surge in inflation, has started to ease. So as a result of that, we might see interest rates come down. So that's why you always want to monitor the jobs report to see what that might actually do to you as a personal owner of your own money. All right. So jobs, good thing, bad thing. It's just more of an indicator and helping you plan to avoid any catastrophes for yourself financially. So let's move into another fun thing. And I've personally moved in the past couple of years. I know a lot of people moved during COVID, and what we're seeing is actually less moving. So last week we actually talked about the rise of forever renters. And while that might be a fact, we're going a complete 180, and now we're talking about people who are home buyers. And we're currently experiencing the lowest amount of home buying per Redfin. And in particular, there's a niche that we're focusing on called relocation home buyers, aka people moving from city to city and buying homes based on the jobs and everything like that. and that migration rate is low. It decreased to about 23.9%. And that's a third consecutive month of decline. So what that really means, um, or what is attributed to less people moving for jobs or for buying a new home, etc. One, reduced availability. There is a shortage of homes available just because a lot of people weren't listing their houses because interest rates. So two, interest rates. Higher interest rates means less people listing homes. Um, and then you also have just a reduced availability of remote work available now. So a lot of people, again, they might have been leaving New York, going down to Florida, working their remote job in Florida for New York. Those companies have now called people back. And so they actually have to make a decision whether they stay with that company or they leave. But nonetheless, that is why there is a record low now of, hey Manny, what's up, man? Why there's a record level of people not moving or buying homes anymore. All right, and then let's get into the final story, and it's about our good old friend Wall Street. And what I mean by that is, hopefully from the visual, again, if you're on Instagram, you can't see this, but you can see that build to rent communities are very much on the rise. And Wall Street is always trying to, try and make a buck, right? That's their job. Wall Street historically, I think I just got one of the dog's hairs in my mouth. Wall Street historically has focused on owning apartment units. Over 55% is owned by Wall Street and retail or investors like that. They're now shifting into single-family homes because single-family homes provide stronger rent growth, longer tenant stays, particularly for families with school-age children like this guy right here. Well, he's not in school yet, so that's why he gets to pull on my ear and do all this fun stuff. But this is now leading to Wall Street not just wanting to get involved in single family, but to actually build subdivisions of houses and be able to rent those out. Now, so far, there's only about 900 such neighborhoods across the country, but I can definitely see that on, it just rocket fuel in the future. Major cities that are getting this right now is like Phoenix, Dallas, Atlanta. But look out for your major city. If you're seeing population growth and job growth and everything like that, then you have a really good chance of seeing Wall Street come in and try to build subdivisions for people like us to be able to rent out. And this is a shift in strategy. So again, if you're in real estate, try to follow what the whales are doing and see if you can do it better. Or think about it from a contrarian point of view. If Wall Street's shifting away from apartment units, then it might make it more affordable to buy apartment units. If Wall Street's shifting away from buying single-family homes and instead building now subdivisions, you as an individual buyer may actually just be competing with another human versus a Wall Street buyer. So it's just a fun strategy to watch and monitor to see how it could actually have an implication for you in the future. Now, let's get into my 3 favorite social posts of the week. And this is going to be shorter because, well, this guy, like I said, is a little sick right now. But here's one that I wanted to hit on first. And I think it's important for all of us to think about. You get manipulated every single day. And it's really quite sad that you get manipulated every single day. And it's something that I actually wanted to highlight for all of us. Oh, yeah, let's keep waving, Curry. Good job. Yeah, keep waving. I'll shift it over to you so you can wave to more of them. And so anyhow, I just want to highlight them. I'll run them off the top. It's use of reciprocity. That's one manipulation factor because you always feel like now you have to return the favor. Emotional appeal, guilt tripping people. That's always a good manipulating tactic. Gaslighting. My niece, she's not on today, but she absolutely. What's up, Artie? She loves using the word gaslighting, even though I don't know if she actually knows what that means. And then using an overpowering presence, being dominant, forceful. That's definitely another way to, try and manipulate people. Constantly criticizing. I try to be a glass half full type of person instead of criticizing. But that's another approach. Playing the victim card. You always hate when people do that. But yeah, playing the victim is one. Distorting the facts, twisting the truth to be in your favor. And hopefully I can just talk through all this. I know, buddy. Devaluation, belittling other people's achievements, making yourself feel like a bigger man. Like, that's all the type of things that people try to pull off in order to manipulate you. So I just want to call that out. Make sure you're aware of that. Sorry, I got to put this guy down. Okay, buddy. It's okay. Okay. So that's one thing I wanted to pull on there. Let's get into another one, and this one might be a little faster one because this is one of my partners, Ivan Viana, and I just wanted to point out one of the strategies he's taken for 2024. One of the strategies I'm taking for 2024 might be a non-crying kid, but I know, buddy, I know. And so he's just talking about his effective method for being able to fulfill 2024. It's okay, buddy. It's okay. I tell you what. Okay, we might have to take this on the move. But for 2024, my partner Ivan laid out this massive calendar that tries to track all of his accomplishments that he wants to achieve in 2024. I'm just curious, other people, what are you trying to do in order to accomplish your dreams? What approach, what strategy are you trying to do, and are you going to stick to it? So that's all I really wanted to highlight with my partner Ivan there. And then this final one that I wanted to touch on is, this guy, Grant Cardone, nobody knows him. Just a no-namer out of somewhere. And he's talking about how to create a business plan for real estate investing. Again, we focus most of this time on real estate investing. So I want to highlight a few things here. Like when you're creating a business plan for real estate investing, it's your business plan for the roadmap to success. And you need to have a clear plan of action if you want to achieve your business goals there. And potentially make your dream of generational wealth and all of that fun stuff that comes with having a good passive income and everything like that. A good business plan could also help you attract great partnerships, like passive investors. If they believe in the business plan and you have a clear entry point and an exit strategy, then that can help you be really successful as a real estate investor, whether you're a passive investor or a syndicator. So don't really skip the step, because your goals as an investor is really your real estate investment strategy, how you plan to use loan funds, investments, and capital, and how you plan to operate and manage those deals. That's how I would summarize it again. So those three things I would summarize as goals of a real estate investor is: what is your investment strategy? How do you plan to use the funds that you get from lenders and investors? And how do you plan to operate and manage those deals? Now, I'm going to shorten it here today just because this guy is not feeling too good. So, family comes first as always. But we're going to go get some milk, and I'm going to let you guys not listen to a screaming kid. But we'll be here next week, and hopefully this guy will be feeling better then. Until that time, take care, everyone.